What's up, YouTube? It's Joe Catfalia sitting on the couch making some money investing in fractional real estate online as usual. Today I'm going to talk about something I mentioned all the time, but I want to get into some of the details of it. And so, one of the huge benefits that I found with fractional real estate investing that is very difficult to achieve with real estate investing in general, is you can have, great diversification. But what does that mean, right? Does that just mean like owning a bunch of different properties? I've talked a little bit about geographic diversification. One, I'm just going to go through the portfolio I've put together so far. If you're new to the channel, I've been a real estate investor for 20 years, but I've only been investing in fractional real estate for the last 5 or 6 months. Um, I have put, quite a bit of time into it, but you know, my portfolio is definitely still a work in progress. I think that there will be, well, when I go through some stats with you, it'll be really clear that I have a lot of work to do. I think the ecosystem right now for fractional real estate investing isn't perfect, and so it's not really easy to get, the as wide a diversification as I'd like. But I think that as all of the platforms grow, that'll certainly change. And the level that I've achieved, even in 5 or 6 months, is miles ahead of anything that I could do, buying whole properties in real life. One of the things that people mention a lot when I talk about diversification and being able to achieve that with real estate and how it's a new thing with fractional investing. A lot of people say, well, what about REITs, right? You've always had REITs, or they've been around, not always, but since the 70s, or I think sometime in the 70s when REITs really came about as a structure. It might have been earlier than that, but sometime around then. And it's true, you can buy public REITs or private REITs that own, a whole bunch of assets and gets diversification that way. But I think, and I've talked about in other videos, I did one specifically when I talked about the Roots platform, Invest in Roots. I compared, what we're doing here to private REITs, and I think I also talked about public REITs. There's a lot of reasons why I'm choosing to do this versus buying a REIT. I think I expect to get better returns. I think that there's a lot of reasons for that. I also think if we execute this well, you could have a lower level of risk. As always, though, just because I make a certain investing decision doesn't mean it's the right thing for you. I'm just trying to share my point of view, the things that I'm doing, my real estate knowledge. As we start to get into diversification, this is, moving away from anything I was ever able to do in real estate. And so, a lot of this is just based on my education, in finance. Early on when I got into real estate, I came into it in a finance role, and so have, some of that classical training. But most of the way I think about this actually just comes from my own personal reading about investing and whatnot. So certainly not an expert in portfolio theory or anything like that. But I want to mention some of the things that I think about when I'm, now that I'm able to diversify in real estate, how I'm doing that. And it is so. And just to give you, I've never been a huge fan of diversification in general. I think that, it's not, a lot of people, I think Kramer used to always say diversification is your only free lunch. But it's not really, right? Because you're giving up both ends of your bell curve, right? You're not going to get the really high end returns and the really low end, right? You're never going to be concentrated in the highest performers if you're diversified, but at the same time, you're never going to be concentrated in the biggest losers. And so, especially in real estate in general, I've had to go all in most of my net worth on individual properties each time as I grew, and I was comfortable with that level of risk because I had more control. So there's a lot of reasons that I got past it, that being an issue, because I think real estate in general provides us with so many opportunities because of what an inefficient market it is. Um, now, now that I have the ability to stay in the asset class that I know and love and feel like I have a real advantage in, and also get some diversification. Well, now I'm pretty happy. I was knowingly giving it up before, and now that I don't have to, uh, I really want to start to think about, different ways that I'm doing it. So I put together a couple of different. So far, this is all of the equities that I have, right? All the properties that I have an equity interest in. I'm going to do my loan interest separate. At the moment, I have pieces of 31 properties. I've actually bought and sold a few. So I've bought up to 34, but I have 31 at the moment. And right now, those are spreading across 18 markets. You can see, and this is something that you can do really easily in Excel. You just put, your market, the number of properties in each one, highlight those cells, and then just insert any kind of chart that you want, and it'll spit it out. And I like to do this to get a good visualization. At the moment, it's not too tough to know that I'm have too many Chicago and St. Louis properties relative to everything else. A big part of the reason that is that's just where the opportunities are on Lofty at the moment, and that's where I'm buying most properties. I'm combating that a little bit by putting, my larger chunks of money to work in some of the other markets, like the Houston and Fort Worth have the largest piece of properties in each of those. Um, but that's one thing to look at, right? You put it together, you see what the pie chart spits out. You can tell, do I have a concentration that I wasn't really aware of? One of the ways this becomes uh, easier to figure out is if this is just a one for one per property ownership, but you can do it in a lot of different ways. You could do it by dollar value, you could do it by unit count, to really see, is there one market that I have a little bit more risk in than others? And then for me right now, the answer is yes, right? There are a few, but because of the level of opportunities I see in those markets, um, I'm willing to accept that, right? And so that's one of the things, you just have to figure out, what it is like. It just helps us understand what those risks are, right? And where we have too much of one thing or not enough of another. Um, but it doesn't mean you absolutely have to change it. But it's a tool to be at least actually being informed and making that decision in a way that, you're not just buying whatever piques your interest, excuse me, and going from there, right? And so like I have been actively trying to find more properties in better markets. At the moment, Lofty doesn't have a ton, right? They have a lot of this, and it's because they have a lot of yield-driven investors, and so that's going to bring them a lot of properties in markets that I'm not super excited about. Part of that's why, Mogul, I put a little bit more in the one property I invested in there, not very much in the other one because I didn't love the property. Um, it's why the few properties in better markets on Lofty, I am just putting larger chunks of money to work, right? And I think that over time, and again too, if you've been watching, following along, I'm really just in experimenting mode. I still have the vast majority of my net worth tied up in, mostly in private mortgages in San Antonio, and so. Um, for a while, that's still going to be the case, but over time, I do expect to put more money to work on these platforms. And when I do, is when I'm going to really want to make sure that, my risk is spread out. Uh, because if that's the benefit I'm getting from moving to here, and so I want to take full advantage of it, right? Another thing that we can look at is, okay, what does our property types look like, right? Or single family versus multifamily versus commercial. At the moment, there are very few commercial options in fractional real estate that are being broken down to the level. Most of them are larger checks that you need to write for each one, kind of like Nectar that we looked at yesterday. But there's actually a lot of different options if you're willing to write real big checks, to get pieces of commercial. But in the truly small fractional space that we've been looking at, there aren't a whole lot of opportunities. It's one thing I'd like to pick up more of that. I feel like there should be. I mean, I started my career in commercial real estate, that before residential, and it is. So I still follow that space and talk to a lot of people there, and it seems like there's a lot of pain in that side of the industry right now, and there just needs to be. I would think there'd be some great deals coming down the pipeline. Hopefully some of those get picked up on platforms like Lofty. And the problem right now is a lot of those sites, are attracting people who are, or, because people are really looking for that type of deal, people are overpaying for it, in my opinion. Some of the more recent larger multifamily property that was on there, I just couldn't get their numbers wise on it. And I think that that's just the case in a lot of the more attractive properties. Before I forget, I would like you to like and subscribe if you don't mind, if you're getting any value out of these. And also, if you're not on any of the platforms that I mentioned, anything that I am actively investing on, I have a link in the description below. They are typically affiliate links, meaning they might pay me something if you sign up, but the reason I use those, they also pay you something for the most part. The Lofty one is still broken. The link will get you to the site, but it won't give you the free money. That's supposed to be fixed next month, but we will see what happens there. Um, and again, do your due diligence on those platforms. Just because I'm investing in there doesn't mean they're the right answer for you. I did use all of those links when I signed up, and so at least at some point in time, they were giving free money for using them. That's it about that. Um, but so yeah, hopefully some of these platforms will or maybe I'll find another one, right? Because I'm always looking. Like to get a little bit more commercial. I don't really care, for me, the small multifamily and the single family. I don't mind this split at all. Honestly, I wouldn't mind having, I think this, of all the types of diversification, this one is between single family and multifamily. I think that's not as important. The commercial, I think, a little bit is countercyclical to residential real estate in some instances, but they all, like right now, I think commercial is struggling a lot more than residential. So I don't think they're countercyclical, but I don't think they're as tied together as a lot of people think. People think about real estate as a monolith, as just one market. And like, for example, right now, office space in a lot of places is a lot cheaper than it was 4 or 5 years ago, where homes in many markets aren't, right? So wouldn't mind picking up more of that, but at the moment, I just haven't seen any good opportunities for it. Another thing that I'm, within the residential space, what type of strategy is being used, right? I have a whole bunch of long-term rentals, just a couple of short-term rentals, one mid-term rental, a couple of rent by the rooms. One of them is that one that's on Mogul. The other one is on Lofty, and then a forward sale. And this is actually that Solslot interest that I bought. And I don't really know what to call this, but it is, that's, I think, the technical term for it. It is, a nifty piece of financial engineering that looks a lot like a home equity loan, but it's not. But you'll have to watch one of my videos on that, or actually just go to the site to try to figure out what that is. But all different strategies. One of the things that I think is a little misleading about this one is I have a whole bunch of long-term rentals, but most of the long-term rentals that I have pieces of, I've bought to convert to just a property that's for sale, right? Like I'm buying it because it's at a discount and I want to put it up for sale. So probably I should have gone through and really figured out which ones am I buying to hold as a long-term rental, and which ones am I buying to hopefully sell in the near term. And I think that this would look much different. I think more than half of this pie chart would look like, okay, that's being bought to be sold sometime soon. Um, and so, okay, overall, it looks like, we've got pretty good diversification. But then also, I've been on Groundfloor, right? And so now we're diversifying between debt and equity. None of the stuff I've been talking about so far has been my debt portfolio, and that this is it, right? These are all of this doesn't include the ones I own whole in real life here in San Antonio, but this is all, I think in real life sounds funny because this isn't make believe, right? We're actually making money here, but it's just all online. So these are all these are all the markets that I own a piece of a ground floor loan in. Um, One of the things that I've noticed is you can see, okay, my biggest piece is in Atlanta. I own several loans there, but also if you really start to look through, I've got Decatur, Georgia. I've got, I don't remember which one this is, but several Georgia markets, and so I have a very strong concentration there. Um, I think that's where the company started. That's my only real thought. If you look at their footprint, um, it's one thing that as I put more money on there, I might pay a little bit of attention to, and still buy. I still want to get as wide as diversification as possible on that platform. I mean, that's what That's how I've able. Oh, and so my stats on this one, right? I've got 86 current pieces, and I am in 71 different markets. Um, Now, another way to look at this would be to break it down by state, and then it would look a little bit less attractive, right? But I do still own several different states. You got Texas, South Carolina, Florida, Alabama, Missouri, Tennessee, Massachusetts. I'm trying to think of where else, but Ohio. So it is pretty diverse, it's in a way that I could just never achieve with my own personal um, note portfolio that I was building, at least not in the manner that I was doing it, right? And so I think because of that, I really like that this is an option. I think that it is, and I was just talking to somebody earlier today about how, um, it's a platform that you don't have to spend a ton of time on. I've spent, less than a tenth as long on ground floor as I have on Lofty, for example, um, because the same company is underwriting all of those loans, and so I've just decided I'm going to buy a piece of every single one for now. Over time, I might start buying smaller pieces of ones in Georgia and larger pieces of ones elsewhere. If I decide that I need to get into that level of being in the weeds with it because I'm looking for a little bit more diversification. I'm honestly not sure. I think it won't be until I have a lot of money on there that I'll be too concerned with that. At first I'll just ratchet up how much I'm putting in every loan, and then over time to just decide, do I want to spend a little bit more time with it. Now that being said, what I just mentioned should make you think, well, okay, well, wait a minute. Yes, you're getting more geographic diversification. You've got a lot less. You have basically one underwriter, right? So you've got that risk of um, it's all just being looked at by the one lender or by the company itself, Groundfloor, and so it's a different concentration of risk, right? And that's why one of the reasons why I'm just looking at a whole bunch of different platforms, right, is that I don't want to, if Groundfloor all of a sudden starts being too relaxed in their underwriting and every single one of their loans is a higher risk than it was in the past. I don't want that to become a problem for me, right? And I think that the way to combat that is to just have other pieces in other platforms as well. So that's I want to talk about that's the way I just have cut it up and looked at it for me, and I think that it's really beneficial to take your portfolio and put it into a pie chart like that, and it makes it like very, at least for me, it makes it easy to visualize, like, okay, what I should be adjusting in ways I can think about it. Another way to do it would be actually to plot them all on a map. I think that would be pretty interesting, but take a little bit more time than I want to do at the moment. Um, and one of the things, the other thing too is, when I talked about looking at states versus markets, one of the things is that's not, I think, as as big of a deal because, for example, like if I'm spread out within a state, like if I'm in Texas, I wouldn't mind having a whole bunch more in Texas than I would in Rhode Island, right? I mean, we got a little tiny state, and if you had a whole bunch in Rhode Island, it's all acting a lot more similarly than if you have a whole bunch in Texas and it's spread out, hundreds of miles apart in different major cities acting in different manner, right? So sometimes the state level chopping things up um, becomes a little bit more arbitrary, right? Like I used to work in Philly, and I worked in New York City, and I lived in New Jersey at the time, and like all those, especially a lot of those markets, like people overlap, and there's quite a bit, and that happens in other places too. But like in Philly, you're very much, New Jersey makes up a whole bunch of your suburbs there, right? And the same thing in New York. You get both New Jersey and you get Connecticut that are, you have suburbs there. And so I think that this, cutting it up by states doesn't necessarily help as much as cutting it up by individual markets. But regardless of that, I want to recap, but then also talk about a couple others. So we talk about location, property type, strategy, type of interest, and that being debt or equity. Um, Also that the forward sale contract that I mentioned, that's you can look at that as a strategy, but it's also the type of interest that you have. So I don't know how to cut that up. Um, but it's one of the things to think about. It is, um, I think it's an interesting strategy, but it is something that it's hard in my brain to place it in, any of the traditional real estate, strategies or classifications. I think the other things that I didn't talk about and I haven't broken up my portfolio on is what manager, right? Like I don't want to have the same manager managing all of my properties. I also don't want the same operator, right? Like there are certain co-own, the operator I might in some platforms like Lofty, that's going to be the co-owner, right? The person who brought it to the platform and still maintains the day-to-day operations. For a site like Mogul, it's going to be actually, they have a third-party manager, but then it's also the platform itself is acting as an operator. Um, you know, it's tough, right? Because I want to pick the very best operators, but I don't want to, concentrate my risk in any one person. There's definitely a few co-owners on Lofty that you see people that just buy a piece of every single property they bring to the platform. Um, I think that's fine as long as you're also in some way, hedging that risk, either buying other properties yourself or maybe they're just investing elsewhere too, right? Maybe it's not all real estate, which is, perfectly legitimate way to diversify if you want. I do buy some precious metals. Um, it's a little bit different, well, I mean, that's a way different risk profile, but I've never been somebody, have it for a long time, been someone who's owned a lot of stocks or anything like that. But if that's what you're doing and this is, something on the side, that's again, I mean, I think that there's not a lot of real downside provided you're able to get similar returns, right? I mean, I'm not going to, um, and that's the thing, whenever I'm looking at like ways to diversify more, I'm not going to pick operators that I think are going to do significantly worse just so I can get some diversification there. And the same thing with like strategy, location. I'm going to try, I want to get roughly the same type of return. Now I say that all the ground floor notes that I have, I expect that I'm going to be making less than I am on a lot of the deals I'm doing on Lofty, but I'm talking about risk adjusted return, right? I mean, those are first mortgages versus an equity position, so you expect it to be lower, um, and not just because you're diversifying into a different asset type, but because it is like a more, um, it's a secured interest. It's you have the ability to foreclose if you have to, and you have equity behind you, right? Like so, on a risk adjusted basis, I want to be pretty indifferent across all my investments, but at the same time, so I'm not going to overdo it, like be like, oh well, I'm not buying another one with this operator because I have too many. It's a balancing act, right? That's part of the reason that I like using the pie charts versus just trying to actually break it out mathematically, because sometimes you can see, um, I think you can visually look at it and realize like, okay, you know, maybe I have twice as many properties in this one place than that one, but when I look at it as a whole, it's not really that big of a deal to have that type of concentration. I don't know. I think it's easier to make those sort of judgments than when you're just doing straight math, because sometimes, especially when a lot of the markets might just have one or two, then you get four or five. That seems like way more, and it is double. But I think that it's not necessarily such a huge issue right now. If I started to get to where, like I pointed out, with the loans, like, okay, that's a pretty big chunk in Atlanta. At the same time, it is, it's not. I don't even think it's a tenth of the portfolio, right? And so, it's, it doesn't worry me that much. But then when I start to clump all of Georgia, all the other Georgia markets in there, was when I started to think a little bit more about it. Um, and then the one thing I talk about quite a bit is, your platform risk, right? Is as far as, um, having the, not just the risk of those platforms going out of business, but also just their business models changing, their fee structure changing. There's all sorts of ways that I'd like to just, that's why I've been trying to spread my money out over multiple platforms, and why I'm always looking for more. And so then again, as usual, if you do find one that you want me to check out, I'd love to do that. I'm trying to stick with ones that, for the most part, are for, who I think this audience is, and it's going to be primarily ones that don't require you to be an accredited investor. I know I broke that rule yesterday, but I don't know, I thought it was a really interesting platform, and somebody had specifically asked. But any of, as long as it's fractional real estate, all the ones that actually are just REITs, I think that it's kind of the same answer for all of them. But if there's ones that really stick out as seeming to be a little bit different, but what I want to do, what I'm looking for is ones where I can buy a piece of individual properties. I think that's what makes it exciting, that we can, expect to make better returns if we can make better decisions based on some real estate knowledge, and that's all I'm trying to do. Um, that's about it. I do have, I am building out a Discord channel. I'm just getting um, some of the, uh, some of the different threads right. Going to make a little intro video. But so what I am going to do is, I'd like to move some of the discussions that we've had in the comment sections. If they're, I'm going to just try to create a place where we can, like, really talk about some of these deals and platforms and stuff, in a separate location. As soon as I get that up, I'll put that link in the description. I probably might even do just a separate video where I just, mention, because what I'm doing is, well, we'll get into that when I do it. Um, but yeah, and that's something somebody in the comments had mentioned. I was already working on it a little bit, but now that I know, there's some interest in having some additional discussions. I got some emails from people. Always feel free to email me, right? To message me. I like having a discussion in the comments, and in places where other people can read it, and which is why I think a Discord might be helpful. I am really active in the Lofty Discord, but at the same time, I'd like us to be able to talk about other platforms, about, be a little bit more critical of Lofty if that's required. Also, maybe come up with some strategies that we want to use to approach certain properties on there. And maybe if we're doing that, we don't want just everybody to know. Um, yeah, I think that's it. So as always, until next time, I'm just going to keep making mistakes so that you don't have to.